I've heard of investors who buy tickers because they like the brand or they feel the chart. That's just speculation. Today we want to look at the business risks and earnings power of a corporation, dissecting the 5 key performance indicators or KPIs that every European sophisticated investor must be aware of. That's the backbone of the corporate structure. Let's get to it. Hello, fellow wealth seekers! Number 1 is revenue, often referred to as top line, the sum of all income generated by the company before taxes or expenses are deducted. We look at patterns such as acceleration, compounding, growth trends, year over year or quarter on quarter to understand whether the trajectory is healthy. Now, there are also a number of things to consider, such as market leadership or positioning, but revenue in itself, compared to peers, helps to understand true market leadership versus what could be stagnant. An example could be ASML versus European Telecom. One has been growing and compounding in size from a challenger to a true market leader, the other one declining and stagnating. Number 2, and possibly my favorite, gross margin. This is intrinsic. It indicates the level of gross profit a company is operating in. Before marketing, research and development, overheads, simply understanding the marginality of the operations of a company, the core commercial operations of a company. So we're looking at pricing power, we're looking at overall positioning. A high or increasing gross margin indicates potential for profit. It indicates what kind of shield the company has should a price war start or competition intensify in the market. An example here could be the Louis Vuitton Group, LVMH, who consistently trades above gross margin of competition, outplaying them and placing themselves as more than a commodity generator, simply as a moat, a go-to staple that can increase prices simply because of the heat of their brand and the positioning with the consumers. Number 3, diluted earnings per share. Also here we're looking at a 12-month pattern, factoring in any dilution because more shares were issued by the company or more was available to buy in the market. We look at the actual effect of earnings per share. You see, revenue is meaningless if the company burns cash while generating top line. Hence, it is extremely important to understand the value, the relative value that is left for shareholders. An example of a leader here is Novo Nordisk, who is, thanks to severe pharmaceutical investments and strong positioning in the market, consistently beat expectations and has placed itself above competition. Number 4, operating cash flow, OCF. Extremely essential to strip away any non-cash essentials, such as accruals or accounts receivable, to understand the actual cash position of a company. For specifically intense CapEx heavy companies such as integrated energy majors, say Shell, this is extremely important. Companies that have to spend a lot on CapEx, on research and development, you want the cash positioning to always over-index the potential expenses for the year to come, to assess the true solidity of a company's operations. Last but not least, the ratio between net debt and EBITDA. This is extremely important for financial reasons rather than purely performance indicators. Here we're looking at the capability of a company to sustain solvency risks. So if you have a company that exceeds a ratio of 3.5 or 4 as a general note, particularly during a time of economic downturn, it means it might not fulfill their debts should revenue drop or falter a little, given the difficulty of the specific economic moment. EBITDA is a proxy for cash before non-cash expenses such as interests and amortizations and before taxes. It is a good proxy for cash flow in itself, and if this is not enough to cover debt, at least with the ratio I just described, you're looking at a potentially shaky situation. And since in 2026 most sectors appear to be cyclical or high growth, where returns are not immediate, they're not constant, price is not the one metric we should look at. The anatomy of a company, according to these 5 key indicators, is what should determine your choices. Have a look at your favorite companies, understand if you're exposed in a proper and safe manner, and safeguard yourself. Until the next session, European Wealth Lab out.